I want to discuss how to invest in the bear market. These are strategies that are designed to protect and to grow your wealth when the market turns bearish. So investing in the bear market where stock prices are declining and investor sentiments are generally pessimistic requires a different approach to protect your capital and find opportunities. So here is how to effectively invest in a bear market. Number one is focus on defensive stocks. Focus on defensive stocks. These will have to do with essential goods and services. Invest in companies that provide essential goods and services such as utilities, health care, consumer staples, which tend to be less affected by economic downturn. Equally have investment in companies with stable earnings. So look for companies with stable earnings, strong cash flow, and a history of weathering economic downturns. Look for those companies with these particular criteria: stable earnings, as well as companies in the essential and in the consumer staples, healthcare and utilities and sectors. Number two is consider value investing. Consider value investing. So in this case, you invest in undervalued stocks. So look for high quality stocks that have been oversold and are trading below their intrinsic values. These stocks may offer significant upside potentials when the market recovers. Look for all those companies that are oversold, that are ignored, that are neglected. When the market corrects, these companies will certainly grow again. So you equally, consider fundamental analysis. So focus on companies with strong fundamentals, such as low debts, consistent profitability, and a competitive advantage or moat around them. Number three is prioritize dividend-paying stocks. Prioritize dividend-paying stocks. So in this case, you to consider reliable income, companies with reliable income. So invest in companies with a history of paying reliable and stable dividends. Dividend income can provide a cushion during market downturn. You also consider what is called dividend aristocrats. Consider investing in dividend aristocrats, companies that have increased their dividends for the past 25 years consecutively. So they are called dividend aristocrats. They've been paying out dividend for over 10 years, for over 20 years, consecutively, consistently. Number four is increase cash reserve. Increase cash reserve. This has to do with liquidity. Maintain a high level of cash reserve to take advantage of buying opportunities as they arise during the downturn. Usually, you come across buying opportunities. So with your, adequate cash reserve, you can utilize these advantages. You equally consider flexibility. Cash gives you the flexibility to make strategic purchases when stocks are at their lowest, and it can equally help you to avoid selling investment at a loss. So have sufficient cash during bearish markets so that you will not end up selling your stocks because you want to raise money. You will not sell at a loss because you want to raise cash. Number five is diversify your portfolio. Diversify your portfolio. In this case, you spread risk. Diversify across different asset classes, different sectors and geographic regions to reduce the impact of market decline on your overall portfolio. Equally consider alternative investments. Consider adding alternative investment like bonds, like gold or real estate, which may perform better in a bear market. Number 6 is use dollar cost averaging. Use dollar cost averaging. So in this case, you invest consistently. Invest a fixed amount of money at regular intervals, regardless of market conditions. This strategy reduces the impact of volatility and lowers the average cost per share over time. It might be on a monthly basis. It might be, on a quarterly basis. Keep on investing a fixed amount of money. As I'm part of this number 6, you also consider long-term focus. In this case, dollar cost averaging, encourages a long-term perspective and reduces the temptation to time the markets. Please subscribe to this channel and like this video. Number 7 is explore safe haven assets. Explore safe haven assets. In this case, you consider gold and precious metals. So consider investing in gold or other precious metals, which are often seen as safe haven assets, during market downturns. You equally can consider government bonds. So these are high quality government bonds. These are high quality bonds that provide stability and income, as they tend to perform well when equities are on the decline. Usually when equities are declining, bonds tend to perform very well, and vice versa. Number 8 is rebalance your portfolio. Rebalance your portfolio. So in this instance, you consider adjusting your assets allocation. So regularly review and adjust your asset allocation to ensure it aligns with your risk tolerance and market condition. Not only that, you reduce your exposure. Consider reducing exposure to riskier assets and increase holdings in most stable investments during a bear market. Number 9 is practice patience and discipline. Practice patience as well as discipline. In this case, you avoid panic selling. So resist the urge to sell investments in a panic. Bear markets are often followed by recoveries, and selling at the bottom can lock in losses. When you sell at the bottom, you end up, incurring losses. Not only that, you consider long-term view. You invest for the long term. So in this case, you maintain, a long-term investment perspectives and focus on your financial goals rather than on short-term market fluctuation. Number 10 is consider short selling or inverse ETF. You consider short selling or inverse ETF. Actually, short selling is not for everybody, because your upside potential is limited, but your downside potential is unlimited, And so when it comes to short selling, for experienced investors, short selling involves borrowing shares to sell them at a higher price and buying them back at a lower price. This strategy can profit from declining stocks, but carries significant risk. It's very, very risky. People that shorted Amazon, they shorted Google, shorted, other technology companies. In fact, they suffered huge losses. So I will not encourage you to get involved in short selling if you don't know what you are doing. So you have inverse ETF. Inverse ETFs are designed to move in the opposite direction of the market, providing a way to hedge against market decline. When it comes to inverse ETFs, when the benchmark is not doing very well, your index fund will perform very well. And if your index fund is up of when the benchmark is performing well, your index fund will perform poorly. It's just an inverse relation you need to consider. So investing in a bear market requires a focus on defensive stocks, value investing, and dividend paying companies. Increasing cash reserves, diversifying your portfolio, and considering safe haven assets can also help protect your capital. So using strategies like dollar cost averaging, rebalancing your portfolios, and practicing patience and discipline are key to navigating market downturn. Not only that, for experienced investors, short selling or inverse ETFs may offer additional opportunities. By adopting these strategies, you can manage risk and position yourself for success in a bear market.